Let's talk about autocallable notes. These financial instruments have become increasingly popular, and it's important to understand what they are before considering investing in them. They're often presented as high-yield, low-risk products, the kind your advisor might be pitching with enthusiasm. But are they really as safe and lucrative as they seem? They promise juicy coupon payments, often significantly higher than traditional bonds. It is making them initially attractive to investors seeking higher returns. And they dangle the chance to get your money back early, a full return of your principal, if the market performs well and reaches a predetermined level. Sounds perfect, right? A win-win situation? But remember the old adage, if it sounds too good to be true, it probably is. There's always a catch. An autocallable note isn't a straightforward investment like a stock or a bond. It's something far more complex. It's a complex debt instrument, a type of derivative, and its performance is intricately tied to the performance of something else. That something else is usually a stock, a basket of stocks, or a market index like the S&P 500. The big selling point is the potential to get high interest payments. You receive these attractive interest payments as long as the underlying asset, the stock or index, stays above a predefined level or threshold. If the underlying asset performs well and stays above that level, the note is called, and you get your initial investment back early, along with the accrued interest. If the asset doesn't perform well enough to be called, you continue collecting those coupon payments, which can seem quite appealing. But the real problems arise when things go wrong, when the underlying asset drops significantly. Here's the crucial part that the sales pitch often downplays or omits entirely. The real risk, the potential for significant losses, is often buried in the fine print of the offering documents. Remember, you're not simply buying a safe and secure bond. You're buying a complex financial product, carefully engineered by banks and financial institutions. And more often than not, the odds are subtly but significantly stacked in their favor, not yours. So before you sign on the dotted line, take a deep breath and truly understand what you're getting into. This isn't a guaranteed golden ticket to riches. It's a sophisticated bet on the future performance of an underlying asset. Don't let the smooth-talking salesperson and the enticing marketing materials lull you into a false sense of security. Take the time to do your own research and know exactly what you're really getting into before investing in autocallable notes. Let's pull back the curtain and reveal how autocallable notes truly operate. We'll break it down, no confusing jargon. Imagine you decide to invest $10,000. This money goes into a note, and that note's performance is linked to something familiar, like the S&P 500 ETF. Now, if the ETF's price manages to stay above a predetermined level, you start receiving attractive coupon payments, perhaps something in the neighborhood of 10% annually. Then, on specific dates outlined in the agreement, if the ETF's price is at or exceeds its initial starting price, the note is automatically called, meaning you receive your initial investment back, along with that final coupon payment. If the market experiences a downturn but remains above a specified lower barrier level, you continue to receive those coupon payments as scheduled. However, if the ETF's price ever dips below that critical barrier, the protective shield you thought you had completely vanishes. And when the note reaches its maturity date, if the ETF hasn't managed to bounce back above that barrier, you're exposed to the full brunt of the loss, mirroring what would happen if you directly owned the stock. That initial $10,000 investment could potentially shrink to, say, $6,000, particularly if the market experiences a significant downturn. So all that seemingly robust protection was, in reality, conditional and dependent on specific market conditions. And once that protection disappears, you're left fully exposed to the downside risk. That's the essence of the trick, the sleight of hand that hides the true risks involved. What's the biggest danger lurking in these complex investments? It's the potential of losing your principal, the very foundation of your investment. This is the money you started with, the seed you hoped would grow. High coupons and enticing yields can easily distract you from the real, underlying risk. The possibility that your hard-earned savings, your nest egg, is on the line. It's a gamble with your future financial security. If the market drops unexpectedly and breaks the agreed-upon barrier, you're left hoping and praying for a swift recovery. But if that recovery doesn't materialize, if the market continues its downward spiral, you stand to lose big, potentially everything you invested. And to make matters worse, your potential upside is often capped, severely limited by the terms of the investment. So, if the market unexpectedly soars to new heights, you don't get to enjoy those substantial gains. You only receive your predetermined coupon payment. You take on all the downside risk, bearing the brunt of any market downturn, but you give up most of the potential upside, forfeiting the chance for significant profit. And what happens if you suddenly find yourself needing access to your money earlier than anticipated? Well, good luck trying to get it back easily. There's barely an active market for these types of notes, making them difficult to sell quickly. And as a result, you'll likely be forced to sell at a significant loss just to get out. Plus, it's crucial to remember that these notes represent unsecured debt, meaning they aren't backed by any specific assets. Therefore, if the issuing bank were to face financial difficulties and ultimately fail, you could potentially lose everything you invested. So, with these notes, you're not just betting on the overall performance of the market. You're also placing a significant bet on the long-term financial stability and survival of the issuing bank itself. That's an awful lot of risk to assume for what ultimately amounts to a relatively small extra yield. Don't allow the enticing promise of high income to blind you to the very real and significant dangers involved. With these notes, you're essentially locked in, overly exposed to potential losses, and ultimately at the mercy of market forces completely beyond your control. Is taking on all of that risk really worth it in the end? Why do banks push these products? Because they're profitable for them. Banks use your money to build a web of options and derivatives, pocketing fees and profits you'll never see. When you buy an autocallable note, you're selling options, taking on risk so the bank can pay you a coupon. The more complex the product, the easier it is for them to hide fees and boost commissions. Advisors love them too. Bigger commissions than simple index funds. They'll call it yield enhancement, but it's really about their bottom line. The prospectus is long and confusing by design. Complexity keeps you in the dark and them in control. If you don't understand it, don't buy it. Remember, Wall Street wins when you don't ask questions. So, who should buy these? Almost nobody. If you're saving for retirement, college, or just want to protect your money, stay away. If you can't afford to lose a chunk of your principal, these aren't for you. If you don't understand options and derivatives, these aren't for you. Only the ultra-wealthy, sophisticated investors who can afford total loss should even consider them. For everyone else, stick to simple, transparent investments. Low-cost index funds, high-quality bonds, things you can explain to a fifth grader. There's no shame in simplicity. In fact, it's your best defense. Don't trade your financial security for a high-yield illusion. If your advisor brings up autocallable notes, just say, "No thank you, your money deserves better."